I see your hand raised.
I just wanted to throw out there if somebody was thinking of a question, maybe something we could talk about, like equity versus non-equity loans, and maybe some just common practices with pricing them, or what you're looking at, what the different exit strategies might be.
Tim, you want me to comment on the pricing there?
Yeah,
Right.
I think it would help.
Yeah, it's definitely comes up quite often because we do have quite a few loans that have equity. So generally, the way that we're determining whether or not the loan has equity or not is payoff, full payoff value, or full loan payoff versus property value. So the LTV number on our tapes is actually principal value divided by property value. So a lot of times there's a big spread between principal value and payoff value. So the LTVs aren't an accurate way to determine whether or not there's equity in the deal. We're actually utilizing payoff, because that's what you're going to receive if you take it all the way to a foreclosure sale, is your full payoff. So pricing on underwater loans, loans that have no equity, range depending on the asset value between, I don't know, say on the low end, 35 or 40% value to as high as mid 60s and even as high as 70% in some markets. There's a really short foreclosure time frame.
So in the chat, Peggy actually had a question regarding, is there additional charge added to the price of a single purchase loan?
No. No, you don't pay broker's fees or seller fees or anything like that. There's no fees. And so regarding loans that have equity, we're going to be pricing those as a percentage of.
Yeah, explain what equity loans, what is the fear from a buyer's point of view of equity loans versus a non-equity loan? Why is a buyer fearful, and why is it a benefit to buy an equity loan?
I would assume that a buyer is fearful that it's going to be litigated or more of a challenge because the borrower has more incentive to want to stay or keep the property. So I would assume that that's one of the reasons why that investors or note investors would maybe want a loan by an NPL that has equity. Conversely, the reason that you would want to buy a loan that has equity is you've got a borrower that has some incentives to stay. So that could turn out to be a really good performing or reperforming loan. And if it doesn't work out, if there isn't a modification or a chance for it to reperform, then you have basically a really great, a much lower risk profile in that you will get your full payoff because there's extra value in the property there that adds a cushion. Does that make sense?
Yeah.
So the risk profile, in my mind, is significantly less on loans that have equity. Again, because you do have that equity coverage and you're almost assured to get full payoff. So as a result, we price those, in the range of say 65% of payoff to as high as, we've sold loans as high as 95% of payoff. Loans that were, like a month away from a foreclosure sale, and it was guaranteed to be a full payoff. So, yeah.
I'm just going to ask Peggy if you can mute your phone just real quick. Thanks. So Ron, I'm looking in the chat window. Ron asked Tim a question of how are you so good at evaluating BPOs and assessing value when value is so critical of all this?
Yeah, that's a good question, Ron. definitely a lot of practice, but you know, when I'm looking through BPOs, I'm really looking for things that don't make sense versus things that do. Seeing consistency in areas, looking at what your subject property is versus the comps in the area, either listed or sold, and making a determination on whether they're actual comps or just a random grouping of properties that are either for sale or sold in the area that the agent threw together. It really has to make sense. And if you think about it from this point of view, that if you had that amount of money that the agent says a property is worth, and you look at the other options available for that price, if you would either pick your property over those properties or any of those properties over your property, then you can kind of tell whether or not the real value might be a little higher or a little lower than the BPO value. So just a lot of practice and look for things that either do make sense and trends, or things that don't make sense, and then ask questions.
Okay, I have a question about due diligence. Due diligence in this business appears to be very important. Where do I turn to for due diligence, and what can I expect in the due diligence report?
So, you know, valuation and title are the two real key components. For title, there's a number of vendors. We use a company called Pro Title. They're based in Philadelphia, and they'll run an ownership and encumbrance report, you know, for right around $100. I think it's between 85 and 100, depending on what level you choose. And they're gonna run, you know, titles so you can see the chain of assignments, so that you know that the person you're buying the loan from is actually the owner of the loan. And they also will run a tax certification. They'll confirm what the current property taxes are. A few of the biggest mistakes we made early on was when we bought loans and we didn't realize there were tax liens. This was a situation where it showed the current property taxes were current, but there was a prior tax lien from 2 years before, and a different vendor didn't catch that. Pro Title catches that stuff, but a different vendor we used had missed some of that stuff. So, we bought a loan that had $30,000 in back taxes that we thought had no back taxes. So, that's the title is that's the key part of it. And then valuation, I mean, there's a ton of companies that do broker's price opinions, you know, first valuation, inside valuation,
Summit valuation.
Summit, yeah, there's tons of companies that do broker's price opinions. I consider it's Tim described, the BPO is one piece of it, but you know, it's taking the BPO and then also doing your own verification, calling an agent, looking online, and really just triangulating the data and to put the best guess on value. You know, fortunately, you know, there's a built-in discount that you're buying these loans at, so you're not always going to be perfect, but you know, the key is to avoid the disastrous miss. If you think the house is worth 80 and it's only worth 70, but you bought it at a discount, you're still going to be okay. If you think the house is worth 80 and it's really worth 30, those are the types of catastrophic mistakes that you know, that you need to avoid. And it's not that difficult to do that. Anyone that has any background in real estate already, you know, you spend a few hours just looking at a new area. It's usually not hard to. It's hard to miss by $50,000 in general. You might miss by 5 or 10, or the house may be beat up inside a little more than you expected. But yeah, that's why you're able to buy these loans at a discount to current value.
Jack, when are you buying drinks again in Vegas? When are we going to have another date in Vegas?
As soon as I get out there again. Hopefully, I don't know if I'm going to make Paper Source this year, just with so much going on, and then I'm getting married over Memorial Day. So,
he said it never stopped you.
Ask him how he missed the tax lien.
All right, go ahead.
How'd you miss the tax
Bring in
lien?
the question.
Hi.
We missed a tax lien because our prior vendor, which we fired, missed it. What had happened is that they just reported the current taxes, and certain states, someone buys a tax lien, they actually have the right to pay the taxes for the following year. So
Right.
when the taxes, if the taxes are current and there's a prior tax lien, you need to ask the taxing authority who paid the taxes. Did the actual homeowner pay, or did the tax lien pay the taxes, which is going to increase the cost of their tax lien? So, things happen. Vendors can miss things, but Pro Title does a very good job. They have not missed anything of note in the 2 years. In the 2 years and 5,000 plus loans, I do not get a commission for Pro Title. I frankly should, but Dave can provide their contact info, I'm sure. Either in the chat or I'm sure Dave can email everyone Alex's info at Pro Title.
Jack, I have another question for you. This is Rob Napolitano, by the way, looking for the drinks. You guys are modifying loans too, or you guys are just, doing the brokering of deals? Are you doing some loan mods in-house there too?
Oh, no, we modify loans every single day. I would much prefer every one of our assets reperform. I'm inherently lazy, and it's nice. I would love to clip coupons and not have to do anything other than collect checks every month. So, if someone requests a modification packet, our servicer sends it out. Our servicer is actively trying to make contact with borrowers, and look, not everyone can be helped, but there's still a lot of people who had a job loss a few years ago that just have the means to resume their payments but don't have a large reinstatement. So those types of situations where it makes financial sense and it's a win-win, we are very very open to modifying loans, and in the situations where the borrower just can't afford it anyway, we prefer to do a deed in lieu of foreclosure or cash for keys, but sometimes you just have to foreclose if there's no other options.
Okay, so that leads me to my real question then. And you may or may not be able to answer this question, because I get two different answers when I ask a question, so I'm just curious your position on it as well. From the tax side, if you're modifying a loan, are there tax implications? I'm being told that there's tax implications because you buy it at a certain basis, you modify, and now the loan is reperforming again. That's a recognized gain because you got it to reperform again. Even though I didn't get any additional money in, I'm being told that could be a recognizable gain as well. And people tell me that I should be buying stuff after they're reperforming so that I'm buying them at a different price, not to get that tax hit. I don't know if you have any input on that at all, but
I'm very familiar with the concept. And with that said, I'm not a CPA.
Yeah, I know you're not the CPA. Sorry, good disclosure. Sorry.
The whole concept of phantom income, I don't think at the level of anyone on this call, it really is going to be a major issue.
Okay.
Because if I were talking to my accountant, I would say just because a loan is reperformed in 1 month doesn't mean it's worth any more money. It's
gotcha.
So if your CPA is asking you, well, if your CPA is worried about reporting phantom income, I think my answer to my accountant would be it's until the loan is performing 12 months, it's probably not worth that much more. Like the day I modify it, over time it may be, but for small buyers that are non-institutional, I think it's overkill to. It's not like a stock where it has a net asset value every single day. It's not a liquid market, and I think most people I talk to, even though that rule is out there, I think. Most accountants have said that especially if you're a small investor, it's just not a liquid enough market to expect you to calculate that and pay tax on it immediately.
Not only was that answer excellent, but you look good on camera too.
I'm wearing a tie because I had to go to court this morning. I appeared at one of our bankruptcy cases, one of our more challenging cases. I actually went up to White Plains and went to U.S. bankruptcy court. So otherwise, I'd be in a.
So do you want to quickly go over? Yeah, the question is for bankruptcy. What worries or scares? Bankruptcy is a scary word to a lot of people. Why don't someone has a question with bankruptcy? Or general question, I guess, right?
What happened if the homeowner files for bankruptcy?
Well, there's two different types of bankruptcy. There's Chapter 13 and Chapter 7.
Right.
Chapter 13 is generally a restructure where the borrower has the ability to take all of their past due payments and pay them back over 5 years. in addition to continuing to pay their ongoing monthly mortgage payment. The Chapter 7 is more of a liquidation. Generally, they're surrendering their property and it's just a complete liquidation. So there are times when someone's filing bankruptcy for good reasons because they want to stay and they want to pay, they want to restructure their debt. There's also times someone may file a bankruptcy one day before the foreclosure sale to just stall the foreclosure process. So the positives we like about bankruptcy is it gives you someone to talk to. They have an attorney, and I find half the battle is getting a hold of the borrower. So when they're in bankruptcy, at least we can call their attorney. We have someone to talk to try to make a deal. If it's bad faith and the whole purpose is to stall, it generally only adds a few months to the process. If they file bankruptcy a day before foreclosure, you can file what's called the motion for relief, and within a few months, usually within 30 days, your motion for relief will be heard, and you can at that point, it basically that pushes that asset outside of the bankruptcy so you can continue your foreclosure. So, there are select situations where the bankruptcy is a nuisance and it's used to stall, but for every one of those cases, there's also a time where they use the bankruptcy process to actually restructure and perform on their loans. We buy a lot of bankruptcies just because it's one of the focuses, it's one of the expertise we have just through our platform. Our parent company had been buying bankruptcy since the 80s, or actually early 90s. So we like that asset class, and a lot of the loans we sell have had a past bankruptcy. In some cases, we may have already done the motion for relief and gotten it out of bankruptcy. In other cases, you may have to do that as a buyer. Generally, those cost $500 to $600 to get a motion for relief, so it's not a significant cost. In addition to the foreclosure costs. The other positive is many of these loans that are non-performing, we've already started the foreclosure. And in some cases, when you get out of bankruptcy, in some cases, you might already be at final judgment and not starting the foreclosure from the beginning because the foreclosure was started prior to the bankruptcy. So even though it may cost you a few $100s to get motion for relief, you may save $3,000 because we already paid for the upfront legal work on the foreclosure a year ago.
For a Chapter 13 restructure, how does it, and if they do restructure, how does it hit your margins? Does it affect your margins at all?
No, on a primary residence, they're not cramming or lowering. They cannot force a modification on you. Generally, it helps the margins because if they pay, they're paying their original payment and they're paying their past due payments, which is split over 60 months. So generally, you end up getting like 1.5 or 1.25 months mortgage payment every single month. So in some cases, you may decide it's better to modify the borrower because it's better for them to pay and not pay. But you can't just have a modification forced on you on a primary residence. There's select loopholes on Chapter 11s. There's always the random case where on an investment property they may be able to do what's called a cram down, where it lowers the balance to what the current value of the house is. But most of the modifications, we're willing to do that anyway. If someone is very upside down, we're willing to forgive some of their underwater balance anyway if they perform on time. So there's no major gotchas with the bankruptcies, or at least for that, as it pertains to your question.
Okay. I have one more question. There seems to be some DoddFrank regulation related to this business. Does it affect the small investor?
There's a lot of stuff floating around. I think we want everyone we sell to use a licensed loan servicer. We won't sell to people who self-service. Shantae from Madison was on the call before. There's a lot of good third-party loan servicers that will handle the compliance part of it to keep you in line and stop you from running afoul of any licensing or any regulatory issue. So there's a fair amount going on. I'm not an attorney I don't spend every day worrying about every regulation. I know there's a fair amount of buzz about contract for deeds, which is a alternative to mortgage, which tends to happen on lower balance assets. So some sellers say they're selling a mortgage, but it's technically a contract for deed. There's some I've seen some headlines about, potential regulation in that space, but nothing that's onerous enough that that's going to stop you from doing deals, and your servicer will be able to hold your hand and keep you out of trouble.
Krupp, one of the questions in the Zoom chat was from Peggy about using a forbearance agreement to determine if a borrower can make on-time payments before granting the mod. If so, to make the PI statements or just PI. I'm struggling with appreciating how it helps the borrower to ask them for a PI when they fail after you mod them, increase the payments by $200. I guess the question is basically saying, would you do a modification when someone increases their payment a month when you're setting for failure?
Well, let me go point by point here. Number one is, yeah, absolutely. We'll do either a trial modification or a forbearance before we do a permanent modification. So, yes, there's usually either a 3 or 6 month trial so that if they do fail, then you don't have to start the foreclosure from the beginning. As far as how much the payment increases, it depends on the situation. We certainly don't want to do a deal where the borrower cannot afford it. We would much rather they actually can pay consistently for 12 or 24 months so that we can sell that loan as a clean performing loan. So, we're certainly going to be careful not to set the borrower up for failure, but sometimes they can afford it. There's situations where maybe a homeowner was out of work for a year, but now they have a decent paying job and they can afford to pay an extra $200 or $300 a month to catch up. So, there are times it makes sense. There are times we've done what's called a cap modification, where we take all of the arrears, add it to the end of the loan, and sometimes we'll also extend the amortization. They might be on a 30-year mortgage. We may make it a 40-year mortgage so that their payment doesn't go up as much. There's a million different ways you can work the numbers to make sure it's feasible for the borrower and it works for you as an investor. And we rely heavily on our servicer to handle that. The servicer handles all the paperwork, all the compliance. We run scenarios ourselves, but the servicer can also run scenarios. So if you're a beginner, your servicer can make recommendations and handle setting up the loan properly with the proper amortization schedule so that everything is accounted for properly.
All right. So you've been doing this for a while, but just along the way, what other mistakes do you remember making?
Oh boy. Yeah, I mean, there's the obvious, like the tax, missing a tax, misvaluing a property, underestimating foreclosure costs in certain states. Fortunately, we haven't had too many major disasters. I mean, I know horror stories I've seen from other people that bought assets and missed a tax sale where they owned the mortgage and they forgot to pay their property taxes, and they lost the property because the tax, the local town basically went to a tax foreclosure. So monitoring taxes is key. A good servicer will track the taxes and monitor, make sure you're not losing your taxes. The business is really not rocket science, and it's really there's not a ton of gotchas as long as you're being diligent. You're focusing on your value, your title report, and a good network of vendors. We've certainly had to find a few vendors over our years, and that's probably I don't have one giant mistake or regret. Fortunately, things have went well since the crash.
Josh, one of the questions was about judicial and non-judicial states and IRS liens. How does that affect our play here?
IRS liens to me are basically irrelevant. It's after foreclosure, you send a letter, and within 120 days, they release the IRS lien. Those are non-issues. As long as it's after your mortgage. If it was before your mortgage and there's not a title insurance policy, then that could be an issue, but that's really rare. So IRS liens to me are no big deal. What was the second part of the question, Dave?
The foreclosure and non-judicial foreclosure states, how does that differ?
Sure. I mean, generally, judicial states can take a little longer and cost a little more than non-judicial, but there's really two different types of judicial states. There's all of the judicials, and there's New York, New Jersey, and Massachusetts that are, you know, really what I'd call the blue state judicial states versus red state judicial states. You know, Oklahoma is judicial, and it still doesn't take that long to foreclose. There's a number of other states, and North Carolina doesn't take that long to foreclose, and it's judicial. So I think there's a price for every loan. There's some people who love New York and New Jersey because they want to be near their backyard. You know, we've always bought nationwide, and I'm not in love with New York, New Jersey, but we'll certainly buy loans there if the price is right. And you know, values of, you know, it takes 4 years to foreclose in Brooklyn, but values are going through the roof. So every year you hold it, you're making 50 grand in property appreciation. So, you know, I think it's important to just keep an open mind and really just look at each deal as it comes, and you know, figure out if there's a price that works for it.
In New Jersey, when you're doing a judicial foreclosure and there's a federal lien on it, I thought it had to go to a sheriff's sale to be an arm's length transaction. And a federal lien is always before a mortgage.
Yeah. Well, are you talking IRS federal lien or some other like
student loan, IRS, everything comes before them now.
The IRS lien, I know we've had a ton of them. The IRS lien, I'm pretty confident, and again, I'm not a lawyer, but we've had a number of situations over the last couple of months. You know, it's basically, it gives them the right to redeem. It doesn't give them a right to take the property from you, but they have 120 days to redeem. But you would actually have to get a full payoff. So the IRS lien, I'm confident about. There's always the random situation. So, you know, if there's a tricky case, it's the type of thing we would call Adam Friedman or one of our foreclosure attorneys and have him look at it. And it's the kind of thing, if you're buying a loan from us and something funny is on the ownership and encumbrance report, you know, I'm not going to just try to talk you into it. I'm going to say, hey, here's Adam Friedman or here's Mark Knuckles. Call an attorney and let them give you an opinion, because, you know, we're very transparent like that, and we want an expert to give you a real opinion. The only situation that's remotely what you're describing that I can think of is one where a guy was literally busted for drugs and he had a federal lien. We actually decided not to buy the loan. It was something we were looking at in diligence, and we weren't sure, but we had the opportunity just to kick the loan from the trade, so we did.
Okay, so let me reiterate my question. They're not ahead of you, they're not ahead of us, but the judicial process will not foreclose, from my understanding, because they want an arm's length transaction. So in other words, if you're taking a mortgage, sure, you're in first position, but what happen is the judge wants to make sure that there's an arm's length transaction, so somebody doesn't go and cut out the tax lien intentionally, or I'm sorry, the federal lien intentionally.
Yes. And most of the time, you're going to have to go through. I mean, unless you know, if there's a lien like that, we're going to plan to go through the foreclosure. So yes, and we actually wanted to go at that point because there's a chance it gets bid at third party and someone shows up at the courthouse steps and just pays us off. A lot of our Florida deals in recent years have sold at the auction, where we're netting in some cases 95% of what we thought our BPO value was by a cash buyer at the courthouse steps. We don't have to pay real estate commission, and we just get paid off. So we actually don't mind them going to auction. And in that scenario with an IRS lien, and we've been through this all the time, what happens is it goes through a standard foreclosure auction. We take the property back as bank if no one else bids. And the IRS has 120 days to redeem the property. So if there's no equity, there's no reason for the IRS to redeem it. I've never even heard of a situation where they do, but you know, let's say it was like a $2 million house and it went to foreclosure, your first position was only $1.5 million and you took it back. That's a situation the IRS might redeem it, give you the $1.5 million, and then take the property, sell it, and make the $500,000 back themselves to pay down their judgment.
Thank you. Any other specific questions at all? Curiosities, wondering? Anyone? No?
Dave, I see Peggy had one more question about the period. It depends. During the forbearance period, is the borrower only paying principal and interest? It depends on whether or not the loan was escrowed. If they were already escrowed, then it would be a PITI payment. If the loan was not escrowed and their taxes are actually current already, you know, we like people to be escrowed, but if they're not escrowed, and sometimes some of these states in the South, the taxes are $300 a year, so it's not really always relevant. And but yeah, if they're not escrowed, it might just be them paying their principal and interest. If it's escrowed, it's going to be both.
Hey, Jack, what's up? It's Rob again. Just mention real quick, it wasn't mentioned, homeowner association liens and how they play a role.
Sure. Rob, you cut out towards the end, but I think I got your question. Most states, you only owe a few months of the homeowners association dues if you foreclose. So Florida, for example, you owe 1 year or 1% of the mortgage balance. So there could be a borrower who hadn't paid since 2009 and they had 80 grand in HOA dues, but you only owe 1 year's worth of dues when you foreclose. And other states, New Jersey is 6 months. So generally you're wiping out a majority of the homeowners association dues. If you Google homeowners association foreclosure and then any state, usually the first site that comes up is called NOLO, N-O-L-O, and it has each specific state on how they treat the homeowners association dues.
Was there any other specific questions at all? Any curiosities? Since I have 5 minutes left in my free version of this session, I'm going to go ahead and let us know where we can connect with you guys, any email addresses. We're going to do a form that I'm going to send to everyone to kind of capture all the information and then direct them to your NDA. Let us know how we can reach you guys and when we can expect additional inventory coming out.
Yeah, right, Dave. So in the chat section there, I put a link to where you can get registered as a buyer. You can reach me via email at notesales@GeminiCapitalManagers.com. And I am going to be putting out a new offering with, I think it's close to 50 loans, either this Friday or early next week. So if you aren't already registered, make sure that you do that if you want to see that tape.
Great. Anything else? Go ahead, Sam.
Let's pick a state of New Jersey. Is it better if once you foreclose on these properties, to put them in the open market, or have if there's a dedicated investor who wants to buy every property that you guys foreclose on? Can that something like that be worked on, or is it better just to keep it in open market and highest bid win?
It depends on the condition and what value band it is. If it's in a owner occupant, if it's in a good enough condition, we can sell to an owner occupant. That's our ideal. We really would prefer to. And Tim manages small rehab projects all the time. If it's paint and carpet and we can actually sell retail, we will. In other cases, if the house is really distressed, there's certain markets we have investor buyers, and sometimes we'll cut our losses and sell something as is.
Okay.
So every situation is different.
All right. So we don't get any lowball offers. What kind of value are you putting on it? Things that don't have equity? Where's pricing nowadays on property?
Right. Yeah, absolutely. Good question, Dave. So like Jack was saying earlier, most of the loans that we have or the assets that we have are higher value. So most of them are 50,000 and up. So pricing on loans that have a underlying property value of greater than 50,000 are generally going to be in the 55 to 65% of value range. Those are loans that are underwater. Loans that have equity, we price those as a percentage of payoff. And that can be anywhere from 65% of the payoff all the way up to 95% of the payoff. And every loan is different. Every loan has a different story. So variables that will dictate pricing are, where we are in terms of the stage of foreclosure. Are we a month away from a foreclosure sale, or are we just getting motion or are we just filing a motion for relief? have we paid taxes? How much have we advanced in attorney's fees? So there's a lot of different, I mean, every loan is different, right? So that's just a general guideline, but overall, we have had quite a bit of success selling loans in the 55 to 65% of value range. That's what the market's paying. So again, like one of the challenges for a smaller investor is thinking maybe there's not enough money or meat in those deals. And I would say that's what the market is paying. So it's reduce your cost of capital and there'll be more meat in the deal for you, you know? So did I answer your question, Dave?
Yeah, that's good, man. Well, I'm going to let everyone end it here. I appreciate you guys' time. And if there are any additional questions, we have your email address, and I'll send it out to everyone here, as well as everyone that was on the webinar. Thank you very much.
You bet, Dave.
All right.
Thanks, Dave.
Jack
Thanks,
just
Tim.
jumped out of here, so.
Sounds good. All right, guys. Enjoy.
All right. You too.
You guys.